Hello and welcome to our Fixed Income Update. I am Siddharth Chaudhary from Bajaj Finserv Mutual Fund. Last month we spoke about market dominated by three concerns: oil, inflation and capital flows. At that time, crude prices were near their highs, Middle East conflict was creating uncertainty and markets were worried about implications for inflation, currencies and bond yields. A month later, the picture looks meaningfully better. Oil prices have corrected sharply, rupee has stabilized, and perhaps more importantly for India, the monsoon has made a strong comeback in the last few weeks. As a result, bond markets have responded positively, with government bond yields declining significantly from the high seen in the month of June. The key question today is no longer whether India faces an external shock. Instead, investors are asking whether the recent improvement can sustain through the second half of the year. First is the US economy, which remains resilient. The US economy continues to surprise on the upside. Growth remains above trend, supported by healthy labor market and ongoing AI-driven investment spending. Inflation remains higher than targets, but with oil prices falling and price pressures contained, the probability of additional rate hikes has reduced. Our base case remains that the Federal Reserves stay on hold in the next meeting. For bond investors, this means global interest rates are unlikely to fall sharply, but risk of another aggressive tightening cycle has also reduced. Japan continues to be one of the most important medium-term stories in global fixed income. After decades of near-zero interest rates, the Bank of Japan is gradually moving towards policy normalization as inflation and wage growth remain firm. The impact will not be immediate, but over time, even modest increase in Japanese yields can influence global capital allocation and fixed income flows. This remains an important trend to monitor over the coming year. Finally, India's macro position has improved. India's external position looks considerably stronger than it did a month ago. The combination of lower oil prices and policy measures designed to attract capital inflows has improved the balance of payment outlook significantly. The RBI's strategy of supporting capital flows rather than defending the currency through higher rates appear to have worked. Concerns around external pressures have reduced materially. In fact, markets that were discussing currency risk a month ago are now discussing growth and duration opportunities once again. Another important development since our last update has been the monsoon. After an exceptionally weak June, rainfall has rebounded in early July, reducing some concerns around an immediate food inflation shock. While Kharif sowing remains below last year's level, improving rainfall should support recovery in the weeks ahead. Food inflation risks have not disappeared, but the outlook today is more reassuring than it was a month ago. The market is effectively pricing a much lower macro risk premium today than it was in month of June. Importantly, inflation fears have moderated, while expectations of aggressive policy tightening have faded. The combination has been supportive for duration. The discussion today is about how long policy remains unchanged while inflation continues to normalize. Our assessment remains that the RBI is likely to stay on board, at least for next one or two policies. On one side, lower oil prices and better monsoon conditions have provided comfort. On the other hand, policymakers are unlikely to declare victory on inflation too early, especially given residual food inflation risk and global uncertainties. Therefore, a pause remains the most likely outcome. For investors, environment has become more constructive than it was a month ago. Carry remains attractive. Short and medium duration strategies continue to offer value. At the same time, improvement in macro conditions has strengthened the case for selectively adding duration. That said, a large part of good news has already been reflected in bond yields. Future gains will increasingly depend on how inflation evolves over the next few months, rather than on further improvement in oil prices or capital flows. If I had to summarize the market in one sentence, a month ago, investors were worried about oil, the rupee, and inflation. Today, markets are discussing growth, carry, and whether the bond rally still has room to run. Thank you for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.